Welcome to yet another edition of Business Redefined, your weekly, most comprehensive look at the world of business, finance, and economics. Part 1 of the Finance Act of 2023 has the provisions on the effective dates, starting from July 1st, 23, going to September 1st, and now we have January 1st, 2024. If you read Section B, there are a number of issues there, including the much talked about e-teams and its provisions, and we are delighted to have on set two FCPAs, that is Edna Gitashi from PwC, karibu sana.
Thank you very much for having me.
Karibu sana. And Robert Orero, karibu sana.
Thank you very much.
Lady and gentlemen, thank you so much for your time. Many Kenyans have sent me questions about the provisions on e-teams, the amendment to the Income Tax Act. Who will be targeted in this? What are the implications? Why are we talking about September 1st, 23, as well as January 1st, 24? Let me kick off with Robert. What is the distinction between the provisions on e-teams regarding September 1st, 2023 and January 1st, 2024?
That's a very good question to start off because there are actually two provisions with effective dates, 1st September 2023 and 1st January 2024. Now, 1st September 2023 is the requirement for any person who is in business to issue an e-teams invoice. That means that anybody who is running a business, be it selling goods, be it selling milk, whatever it is, supplying services, you must issue a Teams compliant invoice or an invoice that has been processed through the Teams platform. So that's the first one, 1st September 2023, and everybody is now required to do that. The next one, which comes into force on 1st January 2024, is the one for claiming the expenses. And what that says is that effective 1st January 2024, if you do not have a Teams compliant invoice, you are not allowed to claim that invoice as an expense. And so if you look at those two provisions, what effectively government was trying to do is to give people some time.
Some window.
Yes, some window to comply. And so that everybody can get onto e-teams so that come 1st January 2024, you are then able to issue proper invoices, proper Teams invoices, and people are able to claim. So that really is the distinction. The first one is for issuance. The second one is for claiming.
Interesting. And maybe just for the sake of our audience, e-teams is the electronic tax invoice management system. We had the transition, that was sometime last year, and we have done episodes on this, so you can just refer to them. And now let me come to you. Again, I've received many questions. Doesn't this thing only apply to VAT registered entities? And I keep telling Kenyans, no, that's not the case. But for the sake of our viewers, just help us understand how we've transitioned from focusing on VAT to now everyone.
Thank you, Julians, for that. I would actually understand where our viewers would be confused around that. So initially, when we rolled out e-teams, it was specifically for VAT registered taxpayers. But now with the changes in the Finance Act 2023, e-teams is going to be applicable to everybody. The provision of the law says all businesses. So whether or not you're registered for VAT, then you'd have to be onboarded on e-teams. And as Robert said, with effect from 1st of January 2024, if you're doing business and your expenses are not supported with an electronic invoice, then you cannot be able to claim that. So that spells out that you don't have to be registered for VAT. It's actually anybody who is going to be claiming tax expenses.
Robert, many Kenyans have written to me on Twitter, sent emails. Mama Mbogo on the streets. Is she expected to be generating invoices on e-teams?
Yeah, and again, that's a very valid concern because if you think about it, and Edna says everybody is required to now issue Teams invoices. So the straight answer to your question is yes. However, just 2 points that I just wanted to add to that. One is the primary reason why you can see Teams has moved from VAT to now everybody is because Kerry has had such a successful run with ramping up VAT compliance as a result of this Teams implementation. And so they're saying, given that performance, I think it grew about 24% or so since implementation. Given that performance, why don't we then move it to also help us show up income tax? And that's why everybody is required to do it. Now, the initial way it had been rolled out was everybody can put in the program on their smartphone. Now, of course, there's a question about availability of smartphones. And what we now know is that Revenue Authority is working on a simplified model. And one of those models is a USSD, which means that even my grandmother who is selling milk at the local kiosk can actually dial star something hash, and it will then be able to generate a message to Revenue Authority, which will then issue that invoice. So there is something that is in the works so that the mama mboga on the street necessarily does not need a laptop or a smartphone, but can still do it. But it's something that is in the works.
Many would say you sound like a career insider there. But but let me come to Edna on the same point.
Yes.
How feasible is this, Edna, that everyone is on this e-Teams generation?
So if you look at the micro, small and medium enterprises, which are very many in this country,
Very many.
technically it means that everybody, including that mama mboga you've talked about, is supposed to be on e-Teams. So what e-Teams is trying to do is to force formalization of businesses. And with formalization, we have certain challenges. Some of the challenges would be even internet connectivity. Before we get that solution that Robert is talking about, that is going to be a challenge. Not everybody has access to that internet connectivity. Think about a dairy farmer, say in one of the remote areas. You have one cow. When you take your milk to the cooperative society, you'll be required to issue your electronic invoice. That might be a challenge. We're talking about USSD. Somebody has to bear that cost of the USSD. So it's also going to be an additional cost to the person who is generating the electronic invoices. And if you think about the information that is going to be stored in e-Teams, basically we're talking about stock management. You're talking about your sales, your purchases, your expenses. These are very key components when it comes to determination of tax liability. So as a taxpayer, you have to make sure that you're keying in the right information. So you must get the right person to do that for you. Then the third thing is that you have to store this information for at least 5 years. So you're coming from a place where I did not need to store this information. Probably I was under the turnover tax regime, or I was under the simplified monthly rental income regime, and all of a sudden you're forcing me to start issuing invoices. And one of the challenges that we have, there are some regimes, special regimes that are simplified. So you're moving, say, let's say the monthly rental income regime. The tax liability is determined on the gross. Very many landlords do not issue invoices to their tenants, especially with residential tenants who are not going to be taking a deduction. But then you're telling this landlord, start generating an invoice. And if you look at the cost of compliance vis-a-vis the tax that will be generated, let me give an example. A landlord that is probably earning 10,000 shillings a month. So the tax on that from 1st of January will be about 750 shillings. But you're telling this landlord, incur these costs of Teams, the USSD, storage, technical capacity, capacity building and all that, the cost might probably outweigh how much is being collected. So I think we need to start talking about thresholds of e-Teams so that it's not everybody who is under e-Teams.
But Anna, just to stay with you on that point, I thought that's the whole idea why we look at the even exemptions of certain categories of people who will not be applying e-Teams, right?
So the exemptions are for specific expenses. They talk about emoluments, and I would understand why. They talk about imports, they talk about tax investments, yeah. But then I'm hoping that we'll be using that window for exemptions to actually expand this list so that we have certain categories also exempt. I've talked about the special tax regime categories, like the simplified monthly rental income. In my view, I think these people should be exempted from e-Teams. We got there because we are trying to simplify it for them. So now with e-Teams, we are making it more complex. So we are going back to where we were. Then talk about the turnover tax. We have thresholds under turnover tax. Between 1 million, the lower threshold is 1 million. So why don't we consider some of these thresholds for exemption? And even for a typical corporation, there are some expenses that you will never get an invoice. Today, if I transact on my phone, I am going to be charged mobile money transfer charges, but I don't have an invoice. But now all of a sudden, I need that invoice to be able to claim that as a deduction. Think about the bank charges. You look at your bank statement, you'll never get an invoice for the bank charges.
But they're charges there.
But they're charges. So basically, it's like we're going to have to rethink our model, our business models. Think about accruals also. Or when you buy airtime, again, you have to have an electronic invoice. So I'm hoping that we're going to be using that window for exemptions to consider certain expenses and also to look at certain categories of taxpayers and exempt them from this provision.
I see. Robert, one of the issues around e-Teams which has sent panic in this market is the issue of stock levels. And from my reading, and you could correct me if I'm wrong, you are supposed to make entries of your stock levels as a business person. And the question being asked is, how will KRA get visibility of the entire landscape? And two, why do they need this information?
Okay, let's start with the second one. Why do they need this information? I think really is about Revenue Authority trying to manage the risk of revenue leakage there in the sense of manipulated stocks. Yeah. And, for example, somebody says, my stocks were stolen, for example. Do you have documentation to back that up, or they were destroyed in the process of maybe moving or rain? So I think that's where they are going in terms of trying to manage these stocks. Now, how are they going to do it? I think by bringing everybody onto iTax or onto eTeams, your supplier will show stocks moving, and we know that they have gone to Julian's, based on the eTeams. Now, at that point, then I come and say, Julian's, I know you've bought 100 pairs of socks, for example. So I expect you to have 100 pairs of socks unless you're wearing them. Yeah. So then you tell me I've sold to Robert 20. And I can see the invoice.
Then they trace it.
Then they can see so I expect you to have the balance of 80. If I come and find that you've got 78, then you must tell me whether you've been removing from your business to wear them and what that means from a tax perspective. That's the way I see this stock management, working. However, like Edna says, there are definitely going to be challenges because, some of the, take for example, the stocks like for petrol stations, yes, where there is natural loss or evaporation. So how do you deal with that from an eTeams perspective? Yes. Take things that, for example, go bad and they need to be destroyed. They need to do from a health safety perspective. So how do you deal with those things? And I think those are the teething problems that we need to anticipate, and it would be good for Revenue Authority to tell, first of all, educate the public on this issue, because there's a lot of lack of knowledge, if I may say so, in terms of how this is going to work, so that people can take up this initiative and ensure that we drive tax compliance. The bottom line, Julian's, here is this. If you can get many more people paying tax, then there's absolutely no reason why your tax rate as an individual should not come down from 35%, for example, to 20%. If more people are paying tax, there's no reason why VAT should not come down to 14%, for example, if more people are paying tax.
I see. Interesting thoughts there. And still on the issue of some of the nuances we have, for example, the petrol stations you have given as a case in point. One question I have received is when the draft regulations prescribe that every invoice must capture the buyer's PIN. In a high transactions environment, supermarkets, etc., how exactly will this work? And I don't know who wants to go first on this, Robert or Edna?
I can go first. So this is not new, Julians. As I said at the beginning, where we had to use eTeams for VAT purposes, we had the same prescription, that the buyer's PIN number had to be included as part of the tax invoice. But what will happen is that if you do not need to take a deduction, either for VAT purposes or income tax purposes, then you do not need to give that PIN number. So what supermarkets and the petrol stations and the like do is that there is an option for you to give those details if you're going to claim a deduction. But if you're not claiming a deduction, I believe there must be a special arrangement where the Revenue Authority will recognize that these are bulk sales, and the users or consumers of these sales are not going to take a deduction, either for VAT or income tax purposes.
Robert?
Yeah, at the risk of sounding like an insider, I know I know there's something in the works in the sense that people are going to have a card that when I go to the supermarket, for example, I flash it on the document reader, and it gives my details so that...
simultaneously.
Yes, simultaneously, so that it says, Robert Warrero, PO Box XXY, PIN number this and that, and then the invoice comes out in my name, so that there's no conversation about whether you should be issuing anybody. I think eventually that's why we are going to head, so that now supermarkets and these high traffic businesses are able to then now issue invoices to everybody, irrespective of whether you are claiming or not.
I received a question on Twitter when I did a thread on this issue of eTeams that what really qualifies for deductible expenses? And this person was asking this question in this context. I run a business. When I do my household shopping, can I have it, because I will have that receipt, can I have it as one of the expenses I'm claiming?
So, Julians, that is a question where somebody is a sole proprietor. So when you're a sole proprietor, you need to separate your personal expenses with the business expenses. So the first thing you'd need to ask yourself, what expenses am I incurring to help in the production of my income? So if you do a house shopping, like in your example, that one is not necessarily related to your business income. But if, say, you're going to take a taxi to go and meet your client, then that's a business income, a business expense, sorry.
But you see, and I like that you've given that explanation, because I gave something similar, and the question was, how does the authority know? Unless out of my own volition I start declaring that this is for my personal business. Because even when if I run an office, I can buy milk for my guests in the office. So how, this person was struggling with the dividing line of what qualifies for personal and what would qualify for business. Because at the end of the day, you'd imagine every taxpayer wants to have as least obligation as possible.
Yeah, I agree that there's obviously that risk, and I think this is where now Revenue Authority looks at it from a risk-reward perspective. The expense that you're dealing with here is, in your example, milk. In the bigger scheme of things, you're running a business that gives you 10 million shillings a year, and you're buying milk worth 50,000 shillings in a year. The tax impact of 50,000 shillings may not be significant, and therefore Revenue Authority may not want to go after that, given the likely yield that they're going to collect or the likely tax. However, if you're talking about other significant expenses, maybe you're going on holiday and you want to pass that to the business, chances are that Revenue Authority will look at a trend and say, could you please explain how this is connected to your business? And I think that's where now Revenue Authority is talking about targeted interventions in terms of audits to protect revenue, so that you're not looking at the 12 million taxpayers or so, but you're looking at this specific subset of taxpayers where we think that there's a risk. Yeah.
Yeah, and maybe, Julian, if I'm just to add on to that, that's exactly why you now have this visibility on ITIMs. So it will be very easy for the Revenue Authority to come and audit Julian's. Yeah. They have all this information, so they'll be conducting the risk-based audits like Robert is talking about. So if they see that you're always either in a loss position or you're claiming very high expenses, it'll be a target for audit. So I think the best thing to do is, let's ask ourselves, whatever expense that is being incurred, is it being incurred in line with the generation of income or not? If it's supporting our income or our business, claim that. If it is not, please do not.
I see. Good point there. When the draft regulations were put out, one of the provisions inside there was that in the event that you have been onboarded on ITIMs and you want to wind up your business, you need to give the authority, I think, 30 days notice. And many Kenyans have asked me, what do you make of this? Isn't this just too punitive for business owners? I'd like your thoughts on that, Robert.
Yeah, I mean, the whole idea here, just remember that the Revenue Authority wants to have visibility over the business. So if you're going to shut down your business and you think you're going to shut down the business, then the law is telling you, as soon as you realize that, or in any event within 30 days or before you shut down the business, let the commissioner know. And the idea here is this. Once the commissioner knows that, then they will be working towards perhaps decommissioning your ITIM's registration, perhaps undertaking an audit, because, before you deregister a business, you have to undergo an audit for purposes of Revenue Authority to give clearance for the business to be liquidated. So the commissioner is saying, I just want that visibility. But again, like Edna says, some of these things are not new, because even under the VAT Act, if you don't think you're going to supply goods that are vatable and you want to deregister, then actually you are required to give the commissioner notice. Even when you're ceasing business, when you want to stop a certain line of business, again, you're required to give the commissioner notice. It's all about visibility for the commissioner so that they can manage that risk. I think the 30 days is reasonable. Of course, like Edna says, there has to be some exceptions, because I wake up one day and there's been a fire, and the business has gone. So I don't have 30 days notice, and therefore the commissioner should be willing to accept that there are certain extenuating circumstances that I cannot give you the notice because the business has just come to an end.
Yeah, no, Robert is right. It's not a new provision. Actually, the Tax Procedures Act also has a similar provision. If there are significant changes to your business, you're supposed to notify the Revenue Authority within 30 days, including cessation of business. So this is just an alignment. And as he said, what the Revenue Authority is trying to do, they want to have visibility of their taxpayers' affairs. So it's only reasonable to know, even for prediction purposes, that if Julian's today will cease to become a taxpayer, I need to also look at my numbers and my projections to see how am I going to do from a revenue projection perspective. So it's not just collection of information. This information is also going to be used for other purposes, I believe.
I see. Robert, there's a Kenyan who asked on Twitter, for those who sell their produce through aggregation, cooperatives, etc., is there a stark difference in terms of how this will apply to them? Do they wait for the cooperative will sort this out, or how does it work? Does it drill down to the individual level still?
Yeah, and I think that's a very good question, because it really depends on how this cooperative is set up. Because if I sell to the cooperative, for example, then I, as a person who is supplying to that cooperative, is in business, and therefore I need to issue an invoice. However, if it's an aggregation center where we say we bring in all our goods and then they are sold, we sell them as a cooperative, we sell them all of us together, then we can decide that because I'm not selling to the cooperative, I'm just bringing to aggregate, and then we sell as a cooperative. Let's have the cooperative registered for teams, because it's the one which will be making the supplies. And then now the cooperative will distribute the proceeds back to the members. And I think those are some of the nuances that we are saying these regulations need to actually consider, because in that kind of a scenario, I don't believe it's right to go to the respective farmers and say, but why haven't you issued an invoice? Because we are aggregating, and that's the essence of aggregation. We're bringing together for economies of scale and etc. So I think that's the way I would envision it working. But like Edna says, these are some of the exemptions or guidance that we would expect from the commissioner in terms of how is this going to be implemented.
I totally agree with what Robert has said. The commissioner has actually asked for comments on the draft regulation.
Yes.
So I'm hoping that Kenyans will take this opportunity and explain their business models to the commissioner and justify cases where they cannot be able to issue electronic tax invoices. Because then it will be very unfair for you to shut down your business because you cannot issue an electronic invoice. We are here to make sure that everybody is generating some sort of income, you're doing your business, and the Revenue Authority is supposed to be facilitating that business. So we hope that this is going to be taken into consideration.
And actually, one of the proposals of the regulations was that the commissioner could exempt some from these requirements. One other issue which has really come to me as questions from many people is, look, you walked us through from ETR to Teams. We got gadgets. Now you're telling us about Teams to e-Teams. For those of us who just got the Teams equipment, do we have again to switch, or how does this now impact?
Okay. So the first thing to mention there is that if you already have the Teams gadget, you do not need to switch yet, because remember the e-Teams is being rolled out. It was rolled out on a pilot basis. It's been tested, and now they are in the process of taking it countrywide. Once it's rolled out, then slowly they will start facing people from the gadgets into the e-Teams. And the idea is once your e-Teams gadget malfunctions or stops operating, then they will take that opportunity to switch you to e-Teams, because at the end of the day, they want everybody to be on e-Teams. And like Edna says, the whole objective of KRA coming into this is visibility. Because KRA, the commissioner wants to sit in her office or his office and look at a heat map on a screen and say, on Du Bois Road, I can see a lot of red, which means that there is a lot of e-Teams being issued. Yes. But on this road, I can see green, which means there is a problem. Can I go and see what the problem there is? That's the whole idea. And so, to answer your question, continue using the Teams device for those who have the device. But once it's ready, you will then need to. Once it malfunctions, then you will need to move on. The other thing I should mention very, very briefly is KRA is looking at about 3 options. There's a KRA generated platform, then some big organizations, like the multi-billion shilling or dollar businesses in this country. They may have their own programs and perhaps third-party developed programs. So at the end of the day, there will be these options where people can move into, and that's what Revenue Authority is exploring.
You're really a regular at KRA.
Has too much information. No.
But Edna, now walk us through as we close the conversation on e-Teams. Of course, Kenyans keep on asking me, what are the penalties? And I hope they're not asking so that they weigh their options, but just for their knowledge's sake.
So according to the regulations, if there is non-compliance, the commissioner is going to write to you. Once the commissioner writes to you, then they are going to, if there is any unpaid tax, you're going to pay 2 times the tax that you have not paid. So if you have been declaring the taxes, then you're likely not to have any penalty to pay.
See, interesting point there. So, still on January 1st, 2024, post-retirement medical provisions, I think that was in the section 35, if my notes are right. What's the whole idea behind this, and why is it a very key provision when it comes to the knowledge of Kenyans who should be taking advantage of this law?
Yeah. So the post-retirement medical fund is an opportunity for people to save towards their retirement, towards their medical costs post-retirement. And so what the Revenue Authority or what the government is saying is just the same way that you save for your pension, start saving for your medical costs. And we'll give you an incentive to do that. Once you do that, we'll allow you 15% of the premiums that you pay towards that, up to a maximum of 60,000 shillings a year or 5,000 shillings a month. So the idea here is, because we know you're going to retire and you're probably going to live another 20 to 30 years post-retirement, assuming you retire at 60, you live to 80, save for that medical cost, and will allow you to get a tax break in terms of a tax relief from that savings. And so it's really designed, in fact, if you look at the way it's been designed exactly like a pension scheme. So the income of the post-retirement medical scheme is exempt, which is the same thing like a pension. The contributions are, you get a relief to a certain extent, and then you'll obviously use it post-retirement, hence the name post-retirement. So that is the whole thinking. Now, as a country, we've gone into universal health coverage. And so some of the questions that we're asking is, how does then this come in? Do I actually need this or do I not need it now that we've got the UHC coming in?
The provisions coming in on the post-retirement relief, yeah. We are in a situation where many of us now are not sure. We have SHIF coming into place. We have this provision.
She has a point. The thing is this, first of all, that thing is in court. SHIF is in court.
Yes.
But fundamentally, if SHIF is going to cover these costs, then why do I need to save into this? In fact, it's basically a dead on arrival kind of proposal, because I don't need to.
Yeah.
After all, I'm paying 2.75%. Why should I look at a guy who is earning 1 million shillings? 2.75% is 27,500 a month. In a year, that's 330,000.
Yeah.
Yeah. So why do I need this? That's a fantastic policy. I don't need to save for this post-retirement.
Maybe just to get your thoughts on the provisions of the post-retirement medical relief. Yes.
Yeah, no, Robert has covered it, and the idea is really to encourage people to take up medical covers, as many as possible. He has talked about the investment income that is being earned by the scheme that is also exempt from tax. Again, another incentive to make sure that the uptake of this product is high. If you look at the thresholds, this is your annual contribution, 15% of that, up to a maximum of 60,000. It actually mirrors what we have for insurance relief. So it is a welcome move for individuals to take up this benefit.
Okay. We also have a provision which I still haven't understood quite in depth, and I don't know who would want to go first on this. The provision on startups and the employment share ownership plans. What really is the provision and why is it important?
Yeah, I can go first on that. So let's start by defining what a startup. So a startup is a business registered in Kenya. The annual turnover is less than 100 million. You've been in business for 5 years, and for less than 5 years, and your business does not include management, professional, or training services. So if you qualify, what happens is that when you're starting your business, you have to inject a lot of capital into your business. You're not breaking even immediately. It will take a bit of time. An average of about 5 years for businesses to break even. Some will break even sooner, others will break even after the 5 years. So what the law is trying to recognize is that in the initial years of a business, it might not be possible to pay employees cash. So instead of paying them cash, there could be allocated shares in lieu of the cash emoluments. So there is some reprieve that is being given to these startups. If you have given your employees these shares, then defer the tax points. And the tax point is deferred to the earlier of 1, when you hit the 5-year mark, or 2, when your employee leaves the business, or 3, when your employee disposes of the business. So it gives, the shares. So it gives the business, the startup business, some leeway in terms of cash flow.
Interesting point. So Robert, then, given the context that Edna has set for us, for me, the question is, what does this mean for startups in terms of taking advantage of this opportunity? And imagine those who are watching wonder, then how do I trigger this, if I could call it? Because let's say I have a business, I actually already have this share ownership structure in place. Given the January 1st, 24, do I go and engage the Revenue Authority, or how does this work?
Okay, so the way to trigger it, Edna has outlined it very, very well. First of all, assess whether you qualify for those conditions, 5 years turnover less than 100 million ETC. So if you qualify, then the next thing is to engage your employees and say, this is how I want to compensate you. And, she's given a fantastic, because startups, if you look at the main startups, they generally will pay you a very small amount of cash, but then they pay you, they give you significant share options, or the options to buy shares in the company. And the idea here is let's work hard, let's grow the business, and then we can dispose of the shares, and we'll all become rich and famous usually in these startups. So for our business which wants to take advantage of that, come 1st January 2024, I think the first thing is to do is put in place an ESOP or an employee share option plan, and you structure it to align with the provisions that Edna has taken us through. These shares will invest in you within 5 years, and then you can dispose them if you want, and then the tax will be paid at that point in time. For the startup, the beauty will be that since these are employee expenses that you've incurred, you actually pay less tax today. However, the employee will pay tax on that benefit from employment 5 years down the line, or when they leave the business. So I think that the key point here is setting up those ESOPs. They can talk to a tax advisor, a lawyer who can set up the ESOP and grant it to the employees. Critical, ensure that you comply with those conditions, because if you don't, then you don't qualify. Yeah.
But by and large, that's a fantastic provision.
Fantastic, yeah. Especially for
the environment we are in, especially. So let's talk about, I was reading Section 7 of the Income Tax Act on taxation on non-residents carrying out business through permanent establishment. Another one which many of us are struggling with in terms of why is this even important in the first place, Edna?
Yeah, so what the law is trying to do is to create a level playing field between companies that are owned by non-residents and branches of non-residents doing business here in Kenya. So up to 2023, 31st of December 2023, if a company was owned by a non-resident, they would pay tax at 30%, their headline rate. If a branch of a non-resident doing business here in Kenya would pay tax, the tax rate was 37.5%. So these two have been harmonized to 30%. But now Section 7 comes in. This company has capital, and there's always return on capital in the form of dividends. So when this company owned by a non-resident is paying dividends to the non-residents, there's withholding tax at the rate of 15%. So to level the playing field on this other side for the branches, when the branch is repatriating income to the head office, then the 15% also kicks in. The only difference is that for the branch, this is the branch that is going to bear it. But in the case of this company that is paying dividend, this withholding tax ideally is a tax liability of the shareholder.
So it basically just evens out the space for companies. And Robert, you think that's a step in the right direction?
Absolutely, absolutely. The only thing that I would say is perhaps we need to revisit that 15% for the branch remittance tax, because it presumes, if you look at the formula, it presumes that you're going to remit everything. You see, for a company, you are given the leeway to decide whether you're going to distribute dividends or not. And you say, I've got a capital project and therefore I do not want to distribute, or the directors do not recommend distribution of dividends, in which case the 15% dividend withholding tax, like Edna was talking about, does not kick in. But you see, for branches, you don't have that leeway. You're just required to say, this was my assets at the beginning of the year, 100. At the end of the year, they were 130. So the difference, the growth in assets there is what minus the tax that you have paid. That growth is what you are deemed to have remitted back to your head office, and that's what is subjected to the 15% withholding tax. So I think there's a bit of cleanup there that may be needed for branches to completely even the playing field.
But I thought by law, and you could correct me if I'm wrong, the commissioner actually has powers to require dividend distribution by firms, right?
Correct.
Yes. So there is a provision of the law under the Income Tax Act that gives the commissioner that power. But the commissioner cannot just use that power to invoke dividend distribution. you have to look at the business considerations. Did I not distribute maybe because I was plying back my capital, I wanted to expand, or what reasons do I have for me not to be able to distribute dividends? So the threshold is very high for the commissioner now to invoke that provision. So long as a business can be able to demonstrate why they're not paying dividends, they're okay. But if the only reason why they're not paying dividends is because of tax, then it will be very easy for the commissioner to then invoke that provision.
Kenyans are looking forward to January 10th. We did see the Affordable Housing Bill 2023. When you read the bill, vis-a-vis what we're expecting, what do you think? Have we addressed the issues which are being raised by the bench?
Well, Julians, I think it's safe to say, because this matter is again live in court, but I think it's safe to say somebody in government took that judgment, sat down with it, and then drafted the affordable bill that we can see. They have addressed a lot of the concerns, and a good case in point. There was an issue about it's unconstitutional in this, or discriminatory in the sense that it's only targeting employed people, yes, or salaried people. If you look at that bill, there's a provision to capture the people who are earning from non-employment income, which basically means business. And again, they'll be paying the same amount of tax. So if it comes to constitutionality in terms of discrimination, that issue has been addressed. There was also the whole issue about is it anchored in law? Yes. We now have a specific law for that. And I think, I don't hold brief for government, but somebody in government is really working with respect to this particular issue. So come 10th of January, assuming this bill is passed as it is, I think we'll probably have a scenario where government has rectified the issue, and therefore the issue of non-constitutionality ceases to be an issue.
All right. And any comment?
No, nothing else to add on that. He's covered it comprehensively.
So as we close the conversation around the provisions kicking in January 1st, 2024, any parting thoughts in terms of the level of preparedness that Kenyans should have, especially around e-teams? Or yes, actually that would be the main issue, because those are the main questions I've been receiving. Any thoughts? Closing thoughts?
Yeah, I think our advice is comply as early as possible, because there's going to be so many people who want to get into this system, and it's not really the easiest system to use. Let me just clarify that. Installation is one thing, but the use, trainer using and acceptability, that's something that Revenue Authority needs to engage in with a lot of focus. But my advice is install these e-teams as early as possible, learn how to use it, generate your invoices, pay your taxes. And by the way, where we're going with these e-teams is that eventually KRA will be completing your return and telling you, Julians, please confirm that your return is accurate, because they already have all the data. So that's why we're going. Yes. So I think the days of people not filing and paying their taxes, I think, is coming to an end. But for me, as a tax advisor, I say, as a country, this is probably a good move, because we get more people to pay taxes, and then we can bring down the tax rates.
Actually, there was a notice from the Revenue Authority on refilling, especially around VAT. And then closing thoughts.
Yes, so my closing thoughts, now that Robert has talked about the taxpayers, I'll talk about the Revenue Authority. Yes. It is my hope that the Revenue Authority is going to facilitate businesses. E-teams is not a one-size-fits-all. We have different models, business models. Yeah. So I hope that the Revenue Authority is going to consider the different business models, the nuances for each of the businesses, apply the provisions for the exemption so that we are able to facilitate businesses, and all of us will be happy making more money for this country.
All right, and that takes us to the close of our conversation. We've actually overshot a bit, but that was an important conversation to have us around effective date, January 1st, 2024, e-teams, relief on the post-retirement medical kitty, and many other issues we have touched on. But the biggest issue that many of you have been sending questions on is on matters regarding e-teams. So yes, we have all the detail here. Stay tuned. We shall keep you updated on any developments. And of course, we look forward to January 10th when we finally get to know the verdict on matters regarding the housing levy. So stay tuned.